Today on Real Estate Backstage, the United States and China agreed to a 90-day de-escalation of the trade war. Inflation was lower than expected in the month of April. 1 in 4 potential buyers are actually waiting for mortgage rates to get below 3% before they purchase their next home. Let's face it, they're probably going to be waiting for quite a while. And we have even more acquisitions on the horizon. Before we jump into the conversation today, if you're watching on YouTube or listening on Apple Podcasts or Spotify, make sure to subscribe that we don't miss any future episodes of the show. And if you're looking for the show notes with links to all the articles that we're going to reference today, you can find that at realestatebackstage.com/episode 29. Now, if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. So I want to kick things off today with this surprise de-escalation with China. This is according to the Wall Street Journal. Quote, a few days ago, it would have seemed almost impossible, but on Monday, to the surprise of global investors and everyday businesses who are fearing a trade war, the U.S. and China agreed to a truce. The world's 2 biggest economies unwound for now most of the tariffs that they had imposed on each other since April in a battle that was threatening to stoke U.S. inflation, crash China's export engine, and upend the global economy. Stock markets in the U.S. and elsewhere surged on the news. The dollar and bond yields rose, reflecting expectations of faster U.S. growth as trade tensions recede. Exporters breathed a sigh of relief. Investors and analysts said the outcome was much better for the global economy than they had expected on Saturday when the U.S. and Chinese negotiators started 2 days of intensive talks at the Geneva residence of the Swiss ambassador to the United Nations. The U.S. agreed to lower the base level of tariffs on most Chinese goods to 30% from 145%. While China said it would cut its levies on U.S. products to 10% from 125%. The 30% rate imposed by the U.S. includes a levy related to China's alleged role in the fentanyl crisis plaguing the U.S., an issue in the weekend's talks. The U.S. tariff on many Chinese products will be higher than 30%. U.S. duties on steel, aluminum, and autos remain in place, as do some earlier tariffs on certain Chinese goods imposed during President Trump's first term and that of former President Joe Biden. Washington and Beijing agree to keep the new tariff levels in place for 90 days, with the goal of working toward a broader deal on trade in further talks. China said it would cancel or suspend some non-tariff trade measures that it had imposed to hit back at the United States, potentially including easing export restrictions on critical minerals used in batteries and other high-tech applications. Speaking at a news conference in Geneva, Treasury Secretary Scott Bessent said the U.S. was seeking a long-lasting and durable trade deal with China. He said a clear break between the 2 economies wasn't desirable and that neither side wants to decouple. Bessent said the U.S. still had grave concerns about its unbalanced trading relationship with China. He cited issues such as China's management of its currency and its subsidies for manufacturing, which Washington believes are a major factor contributing to factory job losses in the U.S. Those and other issues will be discussed in talks over the next 90 days, he said. The outcome forestalls for now what was shaping up to be a destructive clash between the world's 2 biggest economies, with potential ripple effects across the globe, unquote. So it's important to remember that even with the recent de-escalation of tariffs, the tariff rates that we are charging to most countries right now are still significantly higher than what they were before the April 2nd Liberation Day announcement. Now, markets have been reacting very optimistically to these 90-day pauses, these initial frameworks of deals that have been announced, and they, as well, they should be. There should be positive movement in the market because this is a good thing that we're looking for an off-ramp to the trade war. However, like I said, tariff rates now are higher than what they were on April 1st. So that being said, markets should be lower than what they were prior to the Liberation Day announcement, but I think there's just a lot of optimism. Markets tend to be very momentum-driven, so there really isn't any reason for stocks to be trading at a higher rate than what they were before the initial super high tariffs of Liberation Day were announced, but investors tend to trade based on emotions, not necessarily based on logic. All right, so we do have some good news with inflation. The inflation rate was lower than expected in April. This is according to Connect CRE. Quote, the Consumer Price Index, CPI, for April rose 0.2% versus the 0.3% consensus and fell 0.1% from the prior month, according to the Bureau of Labor Statistics. On an annual basis, CPI printed at 2.3%. This was the slowest annual rate since early 2021, falling short of the consensus expectation that it would hold at 2.4%. The Producer Price Index, PPI, fell 0.5% in April, defying expectations of a 0.2% increase, according to data released by the BLS. This was driven by the biggest drop in services since 2009. This follows a revised flat reading in March, previously reported at minus 0.4%, and translates to an annual gain of 2.4%, below the consensus of 2.5%, and significantly lower than the prior 3.4%, revised from 3.2%. April's decline in the Purchasing Price Index offers reassurance to those concerned about potential tariff-driven cost increases. This sharper-than-expected drop suggests potential relief in upstream pricing pressures, which could influence broader inflation trends and the Federal Reserve's policy outlook, unquote. So inflation is still higher than it should be. The inflation problem has not been fully solved. Keep in mind the Fed's target is 2%. However, on both the consumer and the producer side of things, we are seeing the indexes continue to decline. So the rate of inflation is still higher than it should be, but it is coming down, which means we are making progress. We are heading in the right direction. So this is very good news economically speaking, and this is the first batch of inflation data since the April 2nd Liberation Day announcement from Donald Trump. So we're starting to see consumer behavior work its way through the economy as a result of expectations of what's going to happen. Now, like we've said in previous episodes of the show, it can take months for the effect of these tariffs to work their way through the system. And even though we've seen de-escalation, even though we're seeing these 90-day pauses, the tariff rates that are in effect with the de-escalation is still higher than what they were before the April 2nd announcement. So the tariff rates are up, and this could have some downstream consequences in inflation, but it could take several months for that to actually work its way into the backward-looking data. All right, so this is according to RAS Media. Quote, Federal Reserve Chair Jerome Powell signaled today that the central bank is considering key changes to its monetary policy framework. A framework should be robust to a broad range of conditions, but also needs to be updated periodically as the economy and our understanding of it evolve, Powell said in his opening remarks at the Thomas Lobach Research Conference in Washington, D.C. Powell indicated that the Fed is weighing changes to its 2020 framework, including reconsidering the language around shortfalls and average inflation targeting, and potential enhancements to formal policy communications, particularly on the role of forecasts and uncertainty. Clear communication is an issue even in relatively placid times, he said. In periods with larger, more frequent, or more disparate shocks, effective communication requires that we convey the uncertainty that surrounds our understanding of the economy and the outlook. Acknowledging that the economic environment has changed significantly since 2020, Powell said the Fed's review will reflect those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates given the stability of longer-term inflation expectations. Housing economists have also emphasized that interest rates are operating on a different dynamic now, which effectively will keep mortgage rates higher relative to the federal funds rate. Powell further emphasized that these higher real rates may also reflect the possibility that inflation could be more volatile going forward than in the inter-crisis period of the 2010s. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades we have cut the rate by about 500 basis points when the economy is in recession, Powell said. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continues to address that risk. Despite potential framework changes, Powell reaffirmed the Fed's commitment to its 2% inflation target. Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework, and we remain fully committed to the 2% target today, unquote. So a couple things to unpack here. First of all, I think Jerome Powell is expressing some apprehension in general about bringing the federal funds rate too low too early because they want to leave enough ammunition there to be able to actually effectuate change through a shift in monetary policy if necessary. So like Powell said, typically the Fed will lower rates by 500 basis points when we see a recession. If we bring the federal funds rate too low before we enter into a recession, you only leave yourself so much room to do additional cuts. And at that point, you're not going to be able to make really an impact. So if the federal funds rate is already at 1%, cutting it from 1% to 0% really doesn't make that big of an impact. So he wants to leave that tool in his tool belt to be able to do a dramatic rate drop if needed, if the economy really were to go south. Now, the second thing Powell is saying here is that he expects real rates, real long-term rates, to stay higher for longer based on this overall feeling of risk, this overall assumption that inflation could come back at any moment due to supply chain disruptions. This is really going to play itself out in the spreads that we see between, for example, like the 10-year yield and the 30-year mortgage rate. One of the reasons why mortgage rates are where they are today is because the spread is higher than where that spread had been in prior years. And that's typically what happens during this phase of an economic cycle, when there's volatility, when we're in an inflationary environment, when there's a lot of uncertainty, when there's risk of recession. Typically you will see spreads widen. And so even if the 10-year yield were to go down, the mortgage rates are not going to go down by quite as much. All right, so shifting gears, 1 in 4 potential buyers are apparently waiting around for a 3% mortgage rate. This is according to Real Estate News. Quote, the spring home buying season hasn't picked up much steam this year, and some economic forecasters are predicting the market will remain slow through the end of 2025. Although mortgage rates have stabilized in recent weeks, they are still too high for many potential buyers, and younger aspiring homeowners are feeling especially squeezed by steep home prices, a new report from BMO Economics suggests. While most Americans aspire to own a home, many feel that homeownership is out of reach. But even amid affordability challenges and general economic concerns, all hope is not lost, according to Scott Anderson, BMO's chief U.S. economist. The good news is economic and financial conditions can change quickly, so it makes sense to start planning today, Anderson said in a press release. With the right conditions and early planning, younger Americans will still likely be able to attain their goal of homeownership. Of the 2,500 U.S. adults surveyed for BMO's report, 67% said mortgage rates are affecting their buying decisions. This share is even greater among millennials and Gen Zers, as they wait for a rate that feels just right. So what exactly is that ideal rate? Nearly 1 in 4 respondents said mortgage rates need to drop below 3% before they'll consider purchasing or refinancing a home, a scenario that economists see as highly unlikely. Another 15% want rates to be around 3%, and 12% said they would consider making a purchase when rates are near 4%. In his 2025 forecast, NAR chief economist Lawrence Yun said that even that threshold was unrealistic. Are we going to go back to 4% mortgage rates? Well, my forecast, unfortunately, is no, he said in November, adding, I think the new normal will be a 6% mortgage rate. While younger buyers may be more influenced by mortgage rates, the older buyers are actually more likely to hold out for the ultra-low rates. Only 9% of Gen Zers are waiting for rates to fall below 3%, compared to 18% of millennials, 25% of Gen Xers, and 35% of baby boomers, unquote. So the 30-year fixed rate mortgage is likely a once-in-a-lifetime phenomenon that none of us are ever going to see again. Now, could I be wrong? Sure. The only reason why mortgage rates went that low in the first place is because of how aggressively the Fed responded to the recession caused by the COVID-19 pandemic. And knock on wood, that's the type of thing that only happens once in a generation, once in a lifetime, right? Once every 50 to 100 years is when we see this type of global pandemic. In order for mortgage rates to get below 3%, we would have to see such incredibly negative economic data. I just don't see that happening anytime soon. Well, meanwhile, in other news, we have an update on the proposed tax legislation working its way through Congress and NAR's reaction to it. This is according to RIS Media. Quote, President Donald Trump's 2024 campaign platform came with 5 economic policy pillars. One pillar was cutting taxes, with the platform specifically promising to make permanent provisions of the 2017 Tax Cuts and Jobs Act that Trump signed into law during his first term. The U.S. House Ways and Means Committee released a draft of its tax reform bill on Monday, May 12th. The bill is referred to as the One Big Beautiful Bill in the official text, which is the name that Trump himself has used to refer to the legislation. Many of the legislation's provisions impact real estate professionals and consumers. The current draft earned praise from the National Association of Realtors, which has advocated for real estate's priorities to lawmakers during the process. NAR Executive Vice President and Chief Advocacy Officer Shannon McGann said in a press release that this is a very strong opening bid for our advocacy priorities. This draft language preserves or strengthens a raft of provisions vital to housing affordability, including making the current lower income tax brackets permanent. These are all measures we have worked tirelessly to advocate for on behalf of our members. However, despite praising the bill as overwhelmingly positive for the real estate economy and small businesses, McGann said the celebration should not come just yet, and that NAR will continue to advocate for its priorities as the legislation makes its way through Congress. McGann said in the NAR release, I would caution that this is just the first draft. The bill will continue to evolve as it moves through the committee process and eventual passage in the House and Senate, with many amendment votes to come. So during Trump's first administration, one of the major legislative accomplishments was this 2017 Tax Cuts and Jobs Act. But many of the provisions of that law are about to expire, so it's important through legislative action to make those permanent. This is a big part of Trump's campaign promises. Now, looking back at Trump's first administration, it's important to remember that the first time around, he actually got the tax bill done before he started escalating tariffs. This time around, in Trump 2.0, he jumped right into the trade war and started escalating high tariffs, and now he's hoping the Congress will back him up and get this tax bill finalized and make those tax cuts permanent. Now, I think the market has priced in an expectation of a tax bill coming together. If for whatever reason, the House and the Senate, if the Republicans cannot pull this off, if they cannot make those tax cuts permanent, then I think the market is going to drop precipitously. Now, I do think there's a very high likelihood that we do see a tax bill come through sometime mid to late summer. But if, like I said, if for whatever reason they can't get their act together and they can't get that done, a lot of the market optimism right now is assuming that those tax cuts are going to remain permanent. So if that doesn't come to fruition, we're probably going to see a little bit of a negative market reaction. So you may remember that we previously discussed Zillow's announcement that it was going to ban any listings that don't comply with NAR's clear cooperation policy. Well, in an interesting turn of events, rival Homes.com is now offering to boost any listings that Zillow bans. This is according to Inman. Quote, CoStar-owned Homes.com is offering to boost property listings on its platform that have otherwise been prohibited by rival Zillow under the portal's new private listings ban, significantly ramping up a feud between the platforms. Dismissing Zillow's rule as a blacklist against private listings, CoStar Group CEO Andy Florence on Thursday told Inman the Boost tool that it rolled out during its first quarter earnings on April 29th will now be available for listing brokers and homeowners who have been thwarted by the ban in an effort to extend the reach of their marketing across the Homes.com platform and through listing alerts. Homes.com is going to support any agent who gets blackballed or blacklisted by Zillow and boost their listings. He told Inman exclusively on Thursday, adding that access will be free to those impacted by Zillow. We don't think it's right to ban people's listings for your economic interest, unquote. Now, speaking of CoStar, they have now announced an acquisition of yet another search portal. This is according to RAS Media. Quote, CoStar is significantly expanding its international footprint with an acquisition of the Australian portal Domain, one of the largest real estate consumer websites down under, according to regulatory filings yesterday. The deal was previously proposed months ago, with CoStar Group CEO Andy Florence telling investors earlier this year his company could bolster Domain to compete with REA, the dominant consumer portal in Australia, owned by News Corp. Now, News Corp also owns Realtor.com, which continues to battle CoStar-owned Homes.com over domestic residential market share. After initially offering $1.7 billion, Domain agreed to a $1.9 billion offer from CoStar, according to the regulatory filing. The Domain board has carefully considered the CoStar proposal and believes it represents compelling value and a high degree of certainty for Domain shareholders through the cash offer and limited conditionality, the company said in a statement. This proposal is an endorsement of the strong fundamentals of Domain, and we are confident this position will be further strengthened with CoStar support. CoStar had previously taken a 17% share in Domain. Shareholders will vote on the acquisition later in the summer, and the deal must still go through regulator approval. The move marks another aggressive step by the American-based real estate conglomerate to expand its residential footprint. In 2021, CoStar bought Homes.com for $156 million, subsequently investing over $1 billion of marketing into that platform, with a long-term goal of up to $10 billion in subscriptions. In 2023, CoStar bought UK residential portal On the Market for approximately £100 million, which is $125 million, claiming to have increased traffic 212% to that platform. And last but not least, we have Lower set to acquire Ojo. This is according to Inman. Quote, Movado, a portal and technology company that began its journey as artificial intelligence firm Ojo, announced on Tuesday that it is being acquired by mortgage lender Lower. In a statement, the companies said the deal will combine Movado's significant reach with Lower's lending platform and retail network. Together, the two firms aim to create an end-to-end homeownership platform, the statement adds. The companies did not disclose financial details of the deal. So lots of mergers and acquisitions being announced recently, and this should not come as a surprise. Whenever market conditions get difficult, we start to see consolidations. We see companies go through M&A activity in order to better position themselves to address the challenges of the market. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes with links to all of these articles at realestatebackstage.com/episode 29. Now, next week, I'm actually going to be down in Florida for a conference, so I will see you back here in 2 weeks for another behind-the-scenes look at the real estate industry here on Real Estate Backstage.